Don't forget to subscribe, like, and hit the notification bell. Hey everybody, it's Kevin Wadsworth from NorthStarBadCharts.com, and we're here today to talk about gold. It is sending a very, very important, powerful message to the markets right now. We're sitting well above $2,300 as I record this. We're effectively at all-time highs in multiple currencies, and hopefully you're going to have a very good idea by the time I've finished talking here about what is going on and where this is likely to lead, what it means. What does gold at these levels mean, and what have the gold charts been telling us for the last several years, in fact, and how important is it? Well, I can tell you right now that it's incredibly important for your investing decisions, your trading and investing decisions over the coming months and indeed years. And we are seeing the paradigm shift taking place that many people have been speaking about over recent years. In fact, people have spoken about this for many years. And I think it's a case of the fact that you've heard about it so many times. I think there's a lot of disbelief. And even though now it is actually taking place and actually occurring, there are still people out there who seem to think that gold, silver, precious metals, commodities are yesterday's news, and the current price movements don't mean anything and shouldn't really be. We shouldn't be paying any particular attention to them. Well, I'm here to tell you that that is completely false. We are in the midst of an enormous change that will be looked back upon in probably just a few years, 3 to 5 years' time, will be looked back upon as a pivotal moment for the markets. And I'm going to go into some charts here, some technical and scientific proof or evidence, if you like, that what I'm saying here is indeed the case. And we're going to follow that evidence. And by the time we get to the end, we'll have made a conclusion about where this is all leading in terms of stock markets and in terms of investment trends and in terms of precious metals as well. So strap yourselves in. As I say, I'm going to take you through a journey through the key charts. And really, it's just a small handful of charts that are incredibly important here to what's going on. And I've been showing these charts for a while now, but I want to discuss them in a little bit more detail so you get a very good idea what I'm trying to say. So first things first, I'm going to share my computer screen so that you can see the charts that I'm talking about, which would be useful, wouldn't it? And secondly, I'm going to turn my video camera off so that I don't distract you. Okay, now first chart is the gold chart that we're very used to. This is the gold 12-year cup and handle chart. And in technical chart analysis terms, the cup and handle is very well known. It's made up of a geometrically perfect arc and a consolidation period that takes place at some point in the top right-hand corner of that arc. The target is reached and then a consolidation period takes place. Now, this was forecast to last several years, and that indeed is what took place. You can see this red, these two red ellipses here that highlight the move that I suggested was going to happen back in 2019. I'd suggested that we were going to move up to a couple of thousand and then consolidate for a number of years. Well, that took place, and we then hit the low point here, which was on this Ichimoku cloud. That's this green splodge that you can see on the chart here, offers support and resistance on the chart, and we already had a support line forming anyway. So that was the low point, somewhere around $1,600. We then accelerated rapidly and we've broken out. So the question is, breaking out from a 12-year cup and handle pattern, is that significant? What does it mean? What is it telling us? Well, the initial target area is anywhere between perhaps 2,550 and perhaps 2.7 to 2.8, somewhere in that range. It just depends how much momentum gold gets as it powers upwards. Okay, so those are the initial targets, and there's the psychological target, of course, of $3,000. So we will assess as we go along for our website members just when this move is finished and when it's time to step aside. But what we want to really get an idea of is just how historic this move is. What's happening now in terms of the last several decades, in fact, going all the way back 50 years, how big is this move? Well, this is the gold versus PPI chart, gold versus producer prices. So when the chart moves up, gold is outperforming PPI, and when the chart moves down, gold is underperforming PPI. So that you can see from this chart that as a whole, from the 1970s to now, gold has outperformed producer prices. Gold is keeping ahead of PPI, okay, ahead of inflation as defined by PPI. Now, this chart is very important because this upper red line, or the upper line, which I'm just highlighting red now, is key to how big this change is. If and when we cross that line, and this is a semestrial chart, it's a 6 monthly candle chart. So when we get a 6 monthly close above that line, then something big has changed. Also worth noting, we're putting in a series of higher lows on the stock RSI indicator. That was the low point there. Then we put in another low here. And then we've just put in another low up here. So a series of higher lows, which from a technical chart analysis point of view is very bullish. You can see we did the same thing back here in the previous move. It started in the early 2000s. We put in higher lows there, and then up it went. Stock RSI rose, and as soon as it hits this upper zone here, price really accelerates. The ratio chart here really accelerated upwards. So we're looking at a similar turn of events, a similar trend developing here. And if and when we get that 6 monthly close, then that will be massive news for gold. Now we can look at gold versus CPI, and this is on the quarterly chart. So we get a quarterly close. In fact, at the end of June, that's the next quarterly close. March, June, September, and December are the quarterly closes. So a quarterly close above the red resistance line for gold versus CPI will be giving us a huge signal that something big is changing in terms of gold versus inflation as defined by CPI. And again, with this chart, you can see that gold as a whole is outperforming CPI since the ending of the gold standard in the early 1970s. So gold is tracking loss of purchasing power effectively, and in fact, tending to keep somewhat ahead of that. So a quarterly close above that red line will be massive news. You can also see the cup and handle pattern here that's formed on these ratio charts as well. So the gold chart itself, going back to the 12-year cup and handle pattern, we've got the breakout and we're advancing upwards. Now, in conjunction with this, we are looking for capital flows on the gold, the SPX versus gold chart. So this chart shows us rotation, capital rotation. And you can see that capital rotation took place in 1971 there as the chart broke down and the S&P underperformed gold. Gold went on a massive bull run. The same thing happened back here in the early 2000s. The chart broke down in 2002 and then broke down massively in 2004. And we had a huge run for precious metals as gold rose from about $250, I think it was, to over $2,000. So something like at least a 700-800% move for gold from the bottom to the top there. And what's happened since then is we've formed a bearish rising wedge. You can see this bearish rising wedge here. And if and when this breaks down, then that will be telling us that the S&P is underperforming gold. You can see it's already moved down below this green line, which is the 3-year moving average, and it's moved down below the monthly Ichimoku cloud, or it's moving into the monthly Ichimoku cloud. So just a little further movement to the downside will give us the breakdown for S&P versus gold, and that's hugely important because that will be a major confirming factor of capital rotation away from stock markets towards precious metals. The indicators at the bottom are interesting because you can see the distance from moving average in the 1970s breaking below the zero line, and that went hand in hand with the huge gold bull run. Same thing happened here in the early 2000s. In fact, when it broke down here, the indicator moved just below the red zero line, and it stayed below that red zero line for a decade or so. And you can see the downwards trend on the distance from moving average indicator here, and you can see that we're now below the zero line as the chart, the ratio chart moves below the 3-year moving average. So history is repeating for that indicator. The ratio versus SPX, so this is this ratio chart versus the SPX itself, broke down in the 1970s. You can see that breakdown there as it moved below its moving average, and that went hand in hand with a massive bull run. Same thing happened here in the early 2000s, and that led to a massive bull run. And guess what? The same thing's happening now as the black line here trends below the green line. Gold is moving up. S&P is starting to roll over versus gold. History is repeating on that indicator. This is the 84 period, the 7-year rate of change indicator at the very bottom. And as we can see, history is repeating here as well, because in the 1970s, the indicator was trending down and below the green line, which is its 3-year moving average. Same thing here in the early 2000s. It broke down in 2001 below the green line and trended downwards for a decade. And the same thing's happened here. We've broken down below the green line in 2019. Of course, gold went on a very good run at that point, and we are still trending down and continuing to move to the downside. So history is repeating there as well. So the evidence from the SPX versus gold chart is telling us that the probabilities, nothing is certain, but the probabilities are in favor of S&P rolling over versus gold, and gold beginning to outperform the S&P, which is what leads to the precious metals bull era. And just taking a quick look here at the 10-year yield chart, this is to help put in context what's going on. In the 1970s, debt to GDP was falling. It fell from 70% to 31% as gold rose. At the same time, this 10-year yield chart was rising rapidly. Interest rates were rising, inflation was rising, and the 10-year yields were rising. We then had 40 years of descending 10-year yields, inflation being controlled. So that was all good, except that during that time, debt to GDP rose from 31% to 129%. That meant that the 10-year yield had to be contained in order for the debt mountain to be sustainable. We had a false breakdown, a rapid upside move, and we've broken out. We are now in a completely different paradigm, completely different to the last 40 years. The 10-year yield is above the pain line, which means we've got problems mathematically speaking, and those problems are manifesting in the real world economy, because the debt becomes unsustainable because we're above the pain line. The yields in relation to debt to GDP don't add up. So the only way you can make those add up is, as it says over here, that we have serious issues unless GDP rises rapidly. Now, you have to remember that GDP is simply money supply multiplied by money velocity. That is GDP. If you take the chart for money supply times money velocity and overlay it on the chart for GDP, it is exactly the same chart, decade after decade after decade. GDP is money supply times money velocity. Keep repeating that to yourself, and you'll start to understand how you can raise GDP. GDP rises by increasing money supply and/or money velocity. Okay, printing, in other words, would do the trick. So we know what that's likely to do. That's not going to improve the overall debt mountain, of course, but in the shorter term, with rising GDP, makes it more sustainable. But of course, that is just inflating away the issue, which of course destroys purchasing power, which of course is what gold tracks. If purchasing power is destroyed, then gold reflects that. Now, if we go back to the very first chart, this cup and handle pattern, okay, this goes back 12 years. I want to put that in context with this next chart, which is also the gold chart, and the 12-year cup and handle pattern is highlighted here in orange. Okay, that's it there. And this chart for gold goes all the way back, as you can see, to the 1970s. So this important breakout from the cup and handle is setting context here of the last 50 years. And we had a support line, a potential support line at the bottom, but I believe that's no longer relevant. And what is relevant now is this steeper support line. Why is the support line steeper? Well, because gold is reflecting your loss of purchasing power. Purchasing power destruction is increasing. So the rise of gold priced in US dollars is going to increase. Hence, your support lines are going to get steeper and steeper and steeper as time goes by. Gold, in my view, will not come back down to test this lower support line, because that would mean reversing loss of purchasing power to a massive extent. You would need to have house prices at 10% of what they are today, or 20% of what they are today. You would have to have everything around you becoming sort of 80% cheaper effectively. So that's what the reversal of loss of purchasing power would look like. Of course, that's not going to happen. We have inflation permanently embedded in the system now, and that's going to become more and more of an issue. And inflation, loss of purchasing power, stagflation, whatever you want to call it, is what gold tracks. It tracks that, and it's not because gold is going up in value. That's not correct. It's simply that gold is a barometer that is measuring your loss of purchasing power. Gold isn't going up. Your dollar, your pound, your euro is going down, and gold just sits there and measures that. Okay. Now, the critically important part here is this red zone at the top. It's capped the rise of the chart. It's capped the way that gold is reflecting that loss of purchasing power. They've managed to contain the loss of purchasing power to within these limits between the support line and the resistance zone. Now, you'll notice a number of black lines here in this red zone, and that's because you can place a resistance line in a number of different places depending on how you assess the chart. But the red zone encompasses all of those possible resistance line possibilities. No matter where you place them, they fall within that red zone. So when the gold chart moves above the red zone, which means anywhere above approximately $2,700, and certainly once we start approaching $3,000, we are well clear of that red zone. So I do expect some significant resistance between the current price and 2,000, actually a little bit below 2,700. It's somewhere around 2,600, 2,650. And I do expect strong resistance there. And it is likely that gold comes all the way back down and perhaps tests the breakout somewhere around 2,100. Now, that would surprise, shock, and appall many people. And there'd be lots of cries over, oh, the gold bull market is garbage, it's not happening. But this is what the technical chart has been telling us for many years, and it's just behaving perfectly. A pullback wouldn't even cause a blip on this stock RSI indicator on the bottom, I don't think. So a little bit more of an upside move seems likely. If we punch right through 2,700 towards 3,000, I still think that's likely to be a wick on the candle, and I still think that would likely result in a large pullback. So that's the expectation for the shorter term, but for the longer term, I think a more sustained attempt at a breakout, a more sustained move into that area around 2,700 will be obvious when it happens. There'll be a consolidation period near that level, and then the final breakout where that then becomes support instead of resistance. And then I think the SPX rolls over versus gold. Then the stock markets head south rapidly. And at that point, it's incredibly clear to everybody that gold is in a major long-term bull market. Gold, silver, platinum, palladium, precious metals as a whole, along with base metals, commodities, energy, all that kind of stuff, will be in a trending long-term bull market versus the stock markets. Stock markets are likely to have a significant drop, followed by a long, slow grind to get back to those previous highs that may take many, or should take many, many years, during which time precious metals will double, then they'll double again, then they'll double again. So a move that replicates this type of magnitude is entirely probable, and you can see that leads to somewhere in excess of $10,000, could be around $12,000, that sort of region. That would be a realistic expectation. Some believe, of course, that it could go much higher than that. I would have a target area of between $8,000 and $12,000 up here sometime in the late 2020s, early 2030s. So basically during the course of the next 10 years or so, with gold moving up to those sorts of levels. And that seems like a perfectly reasonable expectation, mathematically speaking, and in terms of probabilities and weight of evidence. So huge point here for gold and what it's saying about the markets and what it's saying about the state of the economy generally. And of course, if you panic about that and you think that gold at $10,000 is going to leave us in a world that's falling apart, you have to remember that gold moved from $250 to $2,000 and nobody really batted an eyelid particularly. And back here, gold moved from just above $100 to $1,000. So it went up by a 10 times move there, went up by whatever it was here, something like an 8 or 9 times move from 250 to just below 2,000. So a move of similar magnitude here. There's no particular reason to think that the world is going to fall apart. It just means that you're having zeros added to your currency. So instead of a car costing $50,000, it might end up costing $300,000 or $400,000. And the same can be said for house prices and everything else. And over the course of the next decade, we just get used to bigger numbers, as we did during the period from 2000 to 2012. So it's not necessarily a case of the world falling apart. It's just a case of exactly the same thing happening again, as has happened recently in the year 2000 onwards, and in the 1970s there as well. So it's nothing new. It is just something that you need to be aware of, because you can make your fortunes by being aware of these huge rotations that take place between stock markets and the commodity sectors. Of course, I'm not saying that there won't be problems that arise out of this, because as commodities are more sought after and the dollar price of commodities rises, there are tensions. I'm not saying there won't be tensions, and no doubt, I think, for other reasons as well, over the next decade or so, there are a lot of threats to the economy and to society generally. So, this doesn't help, but I'm just pointing out that it has happened in the past, and the world has managed to survive. So it doesn't necessarily mean the end of the world, although there are lots of other bad indicators out there that relate to that we need to be aware of. Okay, so that's it for this podcast. I think that's put into context my views for precious metals and what the precious metals markets are telling us, and the numbers and the levels that we need to keep a very close eye on over the next few months. Okay, that's it from me for now. I hope you enjoy the rest of your day, and we'll speak to you again very soon. Bye-bye for now.